you see the listing. $500,000. A three-bedroom house, nothing fancy, in a decent zip code that used to be called starter home territory. Your first thought isn't, can I afford this? It's, who can? Good question. The answer is more brutal than you think, and it has almost nothing to do with how much you earn. Start with the mortgage itself. At today's average 30-year rate, hovering around 6.7%, a $500,000 house with 10% down turns into a loan of about $450,000. Run that through the math and your monthly payment, before taxes and insurance, lands close to $20,900. Add property tax and homeowners insurance, and you're pushing $3,400 a month. That's not a guess. That's arithmetic. Now here's where the lender's rulebook comes in. Freddie Mac, the government-backed mortgage giant that helped write the modern rules of home lending, uses a guideline called the 28% rule. It says your monthly housing payment shouldn't exceed 28% of your gross monthly income. Do the reverse math on a $400 payment, and you need roughly $145,000 a year just to clear that first hurdle. Not to live comfortably, just to qualify, but the 28% rule is only half the test. The Consumer Financial Protection Bureau, the federal agency that regulates mortgage lending, layers on a second number, the 43% rule. That one caps your total monthly debt. Mortgage plus student loans, plus car payment plus credit cards, at 43% of your income. This is the number that actually breaks people. Because it's not asking what you make, it's asking what you already owe. So who clears both bars? According to the U.S. Census Bureau's most recent income report, the median household in America earns $83,730 a year. That's not close to the $145,000 threshold, not even in the same neighborhood of the neighborhood. But the census data also shows something surprising. 8% of American families now earn more than $150,000 a year. 1 in 3. That's a bigger slice than most people assume when they picture, who buys a $500K house? Go back 60 years, and that number looked completely different. In 1967, adjusted for inflation, only about 5% of American families cleared $150,000 a year. Today it's 1 in 3. Incomes climbed. But so did the price tag on the house you're comparing them against, and it climbed faster. That's the part the income chart alone doesn't show you. And the strain isn't limited to people still shopping for a house. The Harvard Joint Center for Housing Studies, in its most recent State of the Nation's Housing Report, found that a record 42.9 million Americans' households are now cost-burdened, meaning they spend more than 30% of their income on housing. Nearly a quarter of homeowners, people who already made it through the door, are living in that category. Buying the house doesn't end the math problem. For a lot of people, it just moves the math problem into their living room. So the story should end there, right? A third of families clear the income bar. The rest don't. Case closed. Except that's not what happens. And this is where the math gets genuinely brutal. Picture two households, both bringing in $150,000 a year. Same income, same tax bracket, same zip code even. Household 1 has a $700 car payment, $400 a month in student loans, and $300 minimum on credit cards. That $1,400 in existing debt before a single mortgage dollar is counted. Add the $400 housing payment, and their total debt load hits $4,800 a month, roughly 38% of gross income before you even count groceries or a cell phone bill. On paper, that's within the CFPB's 43% ceiling. In practice, they're one flat tire away from a bad month. Household 2, same income, has no car payment, because they bought a used one in cash 3 years ago. No student loans, paid off already, one credit card, paid in full every month. Their only monthly obligation is the mortgage. Same $500,000 house, same income, completely different financial life, same number on the offer letter. Two entirely different realities behind it. That's the part income alone never tells you. Now widen the picture. Household 1 applies for the same $500,000 mortgage and gets denied, or approved at a worse rate with a larger down payment demanded to offset the risk. Household 2 gets approved without friction, sometimes even beating other buyers in a bidding situation, because their file reads clean to an underwriter. Neither household lied about their income. Neither hid anything. The bank simply looked at the same salary and saw two different borrowers, because the salary was never the real variable. The debt sitting on top of it was. Here's the twist that makes this whole equation stranger than it looks. You'd assume the people clearing $150,000 a year are, by definition, financially fine. They're not. A 2025 report from Lending Club and PYMNTS, tracking the financial habits of American consumers, found that roughly half of people earning $100,000 or more say they have little to no money left over after their monthly bills. Half. Earning six figures. Living the exact paycheck-to-paycheck cycle the starter home generation was supposedly buying its way out of. Why would that be true? Because of something the economist Richard Thaler, who won a Nobel Prize for exactly this kind of research, called mental accounting. It's the tendency to treat money differently, depending on which mental bucket it sits in, instead of treating every dollar the same. A raise doesn't get banked. It gets absorbed. The nicer car, the bigger apartment, the takeout habit, all scale up the moment the paycheck does. Thaler's research showed this isn't a discipline problem so much as a wiring problem. Your brain doesn't naturally treat a $20,000 raise as $20,000 of new capacity. It treats it as permission to spend $20,000 differently. That's why the $145,000 income threshold is almost a decoy. It tells you who can theoretically qualify for the loan. It says nothing about who has actually kept their debt low enough and their lifestyle inflation slow enough to clear the second, harsher test, the 43% rule that's watching everything else you owe. So layer the two filters together. Start with the roughly 1 in 3 families, clearing $150,000 a year. Now subtract the ones whose existing debt, car loans, student loans, credit cards, eats too much of that 43% ceiling to leave room for a mortgage this size. Layer on the Lending Club, finding that half of six-figure earners are already living without a cushion. What started as 1 in 3 households qualifies quietly shrinks into something closer to 1 in 6 or 7. Not because their income disqualifies them, because their debt already spent the room their income created. Think about your own numbers for a second. Not your salary, your obligations, the car payment, the subscriptions that auto-renew every month without a second thought, the credit card balance that never quite hits zero. Every one of those is a small claim staked against the 43% ceiling before a mortgage lender even looks at your file. The house isn't the expensive part. The debt you built while waiting to buy it is. This is also why two people with identical paychecks can walk into the same bank and get completely different answers. It's never really about the number on your W-2. It's about how much of that number is already spoken for by choices you made months or years before you ever looked at a listing. It also explains why a raise rarely feels like it moves the needle. You get the $10,000 bump, and on paper, your theoretical house price ceiling should rise with it. But if the raise buys a slightly nicer car or a slightly bigger apartment first. The 43% ceiling never actually opens up. You're earning more and qualifying for the same house you could already afford 2 years ago, or sometimes a smaller one, because the debt grew at the same speed as the income. This is exactly the trap Thaler's mental accounting research describes. The money was never missing. It was just mentally reassigned before the mortgage application ever saw it. None of this means the goal is zero debt forever, or that a car loan makes you financially reckless. It means the $500 number on the listing was always a shared number with a hidden asterisk. The asterisk is your debt-to-income ratio, and it's silently doing more work than your salary ever will in determining whether that listing is a real option or a daydream. So, back to the listing. $500,000. A 3-bedroom house, nothing fancy, in a decent zip code. Your first thought was, who can afford this? The honest answer isn't a salary number. It's whoever spent the last few years keeping their debt quiet enough that their income still has room to work with. The house was never the hard part. What you did with your money before you saw the listing was.